Hello, folks. Thanks for joining us today. This is Swing Trades Using Options. My name is Eric Wilkinson, and you might recognize me as the Wolfman from mainstream media, but I'm here with Pro Trader Strategy, and my goal is to get you folks to where options just make sense. And please go ahead and smash that like button for me if you would. But I geared this course to introduce traders and investors to options, and I'm sure even this old floor trader can teach the savviest of traders a thing or two. Options can be intimidating, I'm not going to lie, but I'm going to build from simple concepts to real life examples. And by the end of all of this, I believe that you guys will have a solid understanding of options. Like I said, my goal is to get you guys where you understand options intuitively. And I think I can do that for you quickly. Dave, what do you got there? Will slides be accessible? Yes, you can reach out to us at the end here. And I don't think we publish those necessarily, Dave, but we can set you up. All right. So anyway, let's get on with this. We are talking about swing trades using options, and in this particular course, we're going to be talking, or this class, webinar, whatever you want to call it, we're going to be doing it on the long call calendar. Now, first, let's talk about what a swing trade really is. And ultimately, what we want to do when we have a swing trade is define a couple of things. One is, where's my good pen? There we go. So when we're swing trading, we'll see a market kind of trade like that, or sideways, right? It might go sideways or maybe down in a downward pattern. So ultimately, the idea of a swing trade is you identify an overall trend in the underlying. And then what you're going to do is look at these peaks and valleys and try and find the resistance area and the support area. I probably should do a dotted line there. In this case, we've got a sideways trend or a neutral trend, but we can still try and find the resistance and the support levels in and around this underlying and a bearish trend. Then what we want to do is inside of the overall trend, we've got this overall bullish trend. We want to look at what the underlying is doing and identify that pattern within this trend. In the case here, we had a bullish pattern, right? Or a bullish trend, and inside that trend, we've got a bearish pattern, sideways, neutral trend, bullish pattern inside of that overall trend. Again, we have a bearish pattern moving down, or bearish trend moving down, and then a bullish pattern within that overall bearish trend, okay? So we're trying to narrow it down to that pattern, okay? We're looking for that pattern to revert on one of our support or resistances, okay? That's really how you should be thinking about swing trading. On top of that, you can add in a couple of things. You see a candlestick like that at the bottom of a pattern, that's a pretty bullish indicator. So we can continuously try to turn those probabilities in our favor by using little clues that the market's giving us in order to get our strike location or a good opportunity, okay? So ultimately, once we've identified the overall trend, we find those support and resistances, and then we try to find that pattern within that trend, right? So if we were just to use an example like this, we can see that the overall trend is sideways here. We can see that there is a pattern within here, right? And we can find the resistance areas and the support area, right? That's ultimately what we're looking for, is identify that overall trend, find those support resistances, and then identify that pattern, okay? This is where we're going to be trying to find locations to enter into different swing trades, okay? That's ultimately what we're trying to do, is identify that overall trend, find the support and resistances. They're not always perfectly, lined up, folks. Sometimes you're going to have to kind of get that ballpark of where they bounced up against and found that resistance, or bounced onto finding some support there. And you can see it where a lot of different candles, or if you look at bar charts, where a lot of those line up together and it will ultimately build out what is called a market profile, and then identify that pattern. That's the key, folks. That's what we're trading on, is that pattern within the overall trend. So what we'll see sometimes happen, though, is we'll have a bullish trend, and it'll start looking like we've got a bearish pattern, and then it will pop up here, all right, before it starts coming back down, all right? Or you could have a sideways one, and then all of a sudden it pops up or it pops down, right? And you can always see that happen on the downside too. But sometimes we'll see these where they'll break out of that area of support and resistance. And what we do is we stay mechanical when that happens, folks. We know the probabilities. It's going to happen sooner or later. And that's exactly why we would want to look to use option in a situation where we had it break out above that resistance area. Because the options will show you, I'll show you, if this gives you better odds or probabilities. I'm just going to write odds because I don't want to write it all out. So better odds of success. That means you're going to be able to keep your powder dry. If you think about it in that pattern where it started breaking down, that's where you got involved. Well, if you got short the underlying and it popped above before it started reverting, you would have a lot of X. It might have even hit your stop. You might have even pulled the ripcord to get out of this trade off that pop. Well, I'm not saying that's a bad thing. I mean, you're staying mechanical when that happens. But in certain situations, trading options, we would not have had to worry about that at all because of our strike locations, because we know the probabilities of success with these strategies. Some things can go wrong. I mean, we see a lot of times, and this is something I haven't talked about a lot in these webinars, so it's, you know, a good thing that sometimes you watch all of them. If when you get a pattern like this at the bottom, right, and it doesn't matter what colors they are, but the bottom line is you would think that this might start reverting back. But this does show, this candle here does show that momentum is shifting. We could have the next day where then that breaks that pattern. But if you're early to the game and got involved on this trade here, we know the momentum is trading. So it doesn't necessarily mean you would have to get out on that candle with options if you had really good strike locations and you were confident with the overall market continuing to move higher, because you could get another candle like this right after it stopped you out. Or something like what we've just seen recently. I'll pull up a couple charts of the NASDAQ where we saw some bottoming patterns in some of these different stocks. And then yesterday, they just blew the bottom out of it, basically trying to shake out all the weak hands. Well, beauty in options is it gives you a stronger hand to be involved in the trade a little bit longer. It's with the algos and everything else, folks, they know where support and resistances are too. And they try to break those down every once in a while and get all the weak hands out. Well, I think that yesterday was a shakeout like that because we saw that snap towards the end of the day, and like E-mini S&Ps and some of those other ones we'll talk about here. But anyway, ultimately what we're trying to do with these options is turn the probabilities a little bit in our favor. When we're using swing trades, we're trying to set ourselves up for success, right? We're trying to get those probabilities of finding a successful trade. Well, when we add all of those things together, we're trying to use a swing trade to create that successful trade by finding the momentum switch, right? When the switch on the momentum, that's really the best swing trade. And then with options, we can increase our probabilities of success even further. Because they say when you buy a stock, really your odds of success are 50-50. But when we're using options, I'm going to show you how the probabilities are shown to you right there at any given time. So we'll know what our chances of success are going into this. All right, so let's use SPY as an example for today. Now, you guys, if you've been watching the daily market commentaries that I do, you guys have been watching this whole chart setup and everything else, and me playing these trades off of these support and resistances. But it doesn't also always go down and clip those support resistances, right? It isn't always perfect. So sometimes when you're going in there with a stock, it feels like, oh my gosh, I kind of missed that opportunity, like on a day like today, where today would be the day where it looks like there's a bit of a reversal happening here. And, you know, you could, if this was on the futures, it would basically look like an engulfing pattern, which is a bullish signal. And with that said, you know, if you waited to the end of the day, you might be a little bit nervous because you're getting in on what feels to be like a high of this move. But when you're doing options, you're going to get your strike location, you know, where I'm going to be maybe selling a call way up here. So I don't really have to worry about it if it kind of trails back down and actually clips this line. I've already gotten involved, but it was with a strategy where I had success in my favor as soon as I set it up. All right. So if you were doing this with an outlier or an underlying, just going out there and buying the stock, well, you know, you're kind of flipping a coin, to be quite honest. When you're using options, you can weight that coin, if you will, or it feels like you're getting to weight the coin a little bit. So with me, SPY, this is probably, if you were an early or an aggressive trader, I would say SPY looks like it's an opportunity for an upside trade. If we were looking at stocks, you know, another one, everybody loves Apple. Something I always talk about is this point of control. This is called the point of control right here. And this is the volume profile and monkey bars. On the floor, we used to call these the Stoudemire. And really what it does is it's a gauge of where the market finds overall value, all right? So the market finds overall value at $120. Well, you know, if I could buy it right around $120, $125, I'd be pretty happy with that, right? This seems to be a good area of where most people, even analysts, Wall Street, you know, Wall Street bet guys even, are finding value for Apple. So that is an opportunity to, you know, get long if you like Apple. And I'm looking at the chart. We've got this support here. We've got resistance here, right? 136-ish or 137 is that resistance. We've got a value area high right there at 136-ish area. So to me, that would be an area where the market is looking to go to test if we get this rebound. Yes, we do have a little bit of overhead there with the 50-day simple moving average. That should show a little bit of overhead resistance there. But as well as Apple's been doing, I think that they're going to knock it out and bounce to the upside. Notice I have no earnings, so I don't have to worry anything about there. I know that they came out with better than expected earnings there. So that's another way to get me bullish. So for me, that's my bullish argument, right? And it has come down as far as I'm concerned and really kind of tested this value area or this support level, which lines up with the value area or the point of control. It's rebounded up and away from that. So I think that this is an opportunity to get involved. That's just my argument. I'm not trying to sell you guys on it. I'm just what I'm trying to do here is go through this, you know, real life example, you know, from simple concepts to real life examples. Well, that's what we've tried to build here. I'm not trying to talk you guys into this trade. What I'm trying to do is give you guys a little bit of insight into my mind as to when I'm walking through this trade, coming up with an assumption. I'm trying to play by play with you, right? So I've got basically a confirmation to the upside there. So I've come up with my swing trade for a move. So now let's talk about the options real quick. And for some of you guys that are newer to options, let's talk about that. A buyer of an option has the right but not the obligation, okay? So the buyer can but doesn't have to of any option. The seller has the obligation of any option, okay, to perform the contract because we're creating a contract here. And the buyer of the option, the call option contract, the buyer of the call option contract has the right but not the obligation to buy that stock. Now, not just anywhere, it's the strike location, okay? So if I wanted to buy Apple at 125, I could buy a 125 call. That gives me the right but not the obligation to buy Apple at 125. I bought that option. All right. If the underlying goes down, I don't want to buy it higher than where it currently is, so I can let it, expire worthless. All right. I know what my risk was. It's kind of like a synthetic stop in a sense. Whereas the seller of that option has the obligation to deliver the stock. Now, if you don't own the stock and you're selling a call, you would have to deliver that stock to the person, which if you don't own it, that means you're short, okay? You would be short in your portfolio. So the buyer has the right but not the obligation to buy that stock. The seller has the obligation to sell that strike at that strike price, all right? So obviously, naturally, if it's below where we are, nobody wants to buy it higher, right? So you can think about that in your head both ways for the call buyer and the call seller. And then on the flip side, when we're talking about the put buyer has the right to sell that stock at the strike price that they picked, all right? If I buy a 110 strike in Apple, that's below where the underlying is trading. Well, I don't want to sell it right now, but if Apple's trading at 20, then sure enough, I want to sell Apple way up there, right? So there's a value to that. It gives me the opportunity to sell it. It's a stop, but the beauty in this stop, the downstroke is you got to pay for this stop. The beauty in this stop is you know exactly where you're getting out, whereas a stop you could get out anywhere. So the buyer has the right but not the obligation to sell the stock at that strike price. The seller of a put has to buy that stock at that strike price, okay? So if the underlying goes way down and I sold that put, I'm going to have to buy it up there, okay? So keep those levers and pulleys working in your head. The call buyer can buy the stock. The put buyer can sell the stock. Another way you can think about it is when I was teaching kids on the floor how to arb and to trade stock and all of that stuff, is we would talk about it like this, is if you made the phone signal, the hand signal, you call up or you put down. So it's all like the phone. You call up or you put it down, all right? Call up, put down. That's the idea of the buyer's perspective. All right. First thing we need to do when we're trying to spot the right option strategy is to determine whether those options premiums are expensive or are they cheap, right? I mean, we don't want to buy something when it's super expensive. And if there was a way to gauge if these premiums were expensive or cheap, then obviously that's going to be beneficial, right? If they are extremely cheap, I know that I'm getting them as cheap as they've been in the last 52 weeks. If they are expensive, I know I'm getting them where they are the most expensive out of that duration, right? But how do we determine that? Well, one would say maybe go over and look at the option montage here, right? So I'm looking at Apple. I've got that bullish assumption that I'm not trying to sell you guys on. I'm not involved in Apple and I'm not necessarily sure I'm going to put this trade on, all right? So, but I might tomorrow. I usually talk about these in the video, and then I'll talk about the trade if I do it in the daily market commentaries, folks, because I don't want to be anybody thinking that I'm doing a pump and dump. So ultimately, what we're trying to determine is in the option montage, which is this page, which shows all the calls and all of the puts, right? And the different expiration months. You can see the whites are in the monthlies, the yellows are the weeklies. So all of these are what the premiums are, right? All of these are premiums, the cost of the different strikes. Okay, so the premiums are correlated to that strike, all right, horizontally. So when we're looking at this, are they expensive or are they cheap? Anybody? Well, you can't exactly tell. You can kind of tell with this strategy, but I'm not going to give that cat, I'm not going to let that cat out of the bag just yet. So what we need to do, normally our first step is going to be looking over here at the options charts. And over down here at the bottom, you can see that I have implied volatility, and I pulled that up as a chart because I want to see where this underlying implied volatility is, which is just the same thing as I was talking about in the last page. Over here is the pricing. We needed to look at this number here, Vega, all right? And the spot month is really going to be the one that is the closest number that we're looking for, which is spot month is the one that's usually right around 35 days to expiration. All right. So this number ultimately, it shows up in a lot of different places, and it's called Vega, or it's really implied volatility is where you'll see it show up a lot more. But just know Vega is implied volatility, folks. Okay. Vega is volatility. Vega is implied volatility, to be more specific. So we want to look at, because every underlying implied volatility coefficient is different, all right? Every underlying has its own implied volatility. That's what I want to know. I don't want to know what the VIX is in order to tell me if options prices are cheap or expensive, because while the VIX is spiking, well, the underlying I'm looking at might not have volatility spiking. It can happen. It will happen. It does happen a lot. All right. So what we need to do is look at this underlying implied volatility, because it's like a swing trade also. It has support and resistances. It has a trend, which is generally neutral. And then it has support and resistances and a pattern within that. And that's what we're looking for. So implied volatility. We can see where the high is and the lows, but I've been basically wiping everything out. I'm only looking at the last 6 months anymore, just because with the pandemic, some of that volatility is still causing the data to be a little skewed as far as I'm concerned. So I'm trying to negate all that. And I have the script for you guys. Like if you're doing Thinkorswim and you have the implied volatility percent showing up in the option montage or other places where I'll show you, I have the script over there in the watch list. You can change it to be where it's only the last 6 months. So we can see where the resistance is, support, right? And it looks like the pattern within the trend is going down, but it is looking like we have relatively, maybe even elevated volatility right now. So we're getting some mixed signals here on this one. But what we can do is immediately kind of look at it high, low, and see that this is slightly closer to maybe the lower end of the range there. So what we could do is pull this out. It gives us a little bit better when you zoom in on it. And let's just call this 56 as the high, and let's call this down here at the low 26. And currently we're going to call this right around 33. All right. So if you guys really want to dig into the math, or you don't have the script to only get, take out some of that noise I talked about, right? Well, here it is. So you basically take the current implied volatility minus the low implied volatility, and you take that sum and divide it by the high implied volatility minus the low implied volatility. So you can see we're trying to basically find out where the current is in relation to the high and the low. So basically we're trying to find out where this number is, within this range. Okay, so we take the current minus low, 33 minus 26, we got 7. 7 divided by 30, and I'm going to have to pull up your calculator. 7 divided by 30, so 23 percentile. So, all right, so it's in the 23 percentile. And what I say is if it's less than 50%, if this number is less than 50% here, right, then you're looking to buy. All right. And if it's greater than 50%, you're looking to sell. Okay. So we're right around 26 percentile. this is the buying area, or the selling if you want to spot it quickly. Just kind of do that ballparking. Like, that's the easiest way to spot if they're cheap or expensive, is you look at this chart at the bottom when you're looking at flipping through the charts. And if I can erase all the ink, you can tell that point right there is at the lower end of the range. So if you want to flip through charts and just spot the pricing to see if they're cheap or expensive, then that's the fastest way to do it. So in that case, I would be saying, all right, well, it's relatively cheap, so I'm going to be looking at buying options. Well, if I'm looking at buying options, well, this is what I wanted to talk about here. Sorry, before I get involved in that. Before we get too involved in talking about that option. So this was what we generally are going to be looking at for whether they're cheap or expensive. So now we've determined they're pretty cheap. Another step with this strategy, and if you're looking at trying to narrow down what strategy to use, you need to check this out. Well, we know they're pretty cheap, which would then say, we're looking at buying further out in time, and I'll explain that a little bit here as we're going. But with this strategy, we also need to look at the difference in Vega between the different months, okay? So we can see it's 33 here and 34 here. What I want to make sure you guys are aware of is we do not want a major difference between these two. As a matter of fact, we want it to be less than a 3% increase, okay? Less than a 3% increase. If you're considering doing a calendar or even a diagonal for that matter, okay? And we'll talk about the diagonal next week. But the reason why is because we're doing a long call calendar. And when you buy a long call calendar, that means you're buying the longer duration, folks. And, if I were to be looking at a strike right here, I would be having to think, all right, if there is a major difference, if this number here was 5, 6, 7, 10 percentage point difference increasing, that means if I'm buying out here and selling in here, then I'm going to be paying. These are going to be super expensive. If you've ever looked at Yelp, it's going to be like a 5-star expensive, and this is going to be a 1-star expensive, right? You're selling cheap and buying expensive. We don't want a major increase in this number to this number, okay? Is that clear? Did I make that pretty clear? Stay away from that. Now, we will see situations like this where you can see for one, the Vega coefficient is completely different, and we don't know if squares premiums are expensive or are they cheap based on this number. But one thing I can tell you is if I'm looking at this number as 60 and this number as 53, what does that mean? That means these are cheap compared to these. Now we're looking at this being the Yelp review, right? And this being cheap. Like that, if you were looking at a perfect scenario for a calendar, this is really what you're looking for, all right? It's a situation where it's flipped, because usually volatility, Vega, affects further duration options more. We've gotten this little bit of volatility recently, especially since the pandemic, and we're actually seeing a lot of these front months volatility get jacked up quickly versus the further duration. And I've got a lot of theories as to why that's happening right now, but it doesn't matter. We can take advantage of it. So if you ever see a situation like this, you know that that is like a full-on green star, like you write about type of scenario for a calendar, all right? Super cheap out here, and you can tell if I can't tell if they're cheap or expensive for the last 52 weeks, but what I can tell you is whatever it is, it seems like it's a bit of mispricing for a calendar. Now, for a swing trade, I don't like the setup in the thing, because I was actually looking at this example earlier on today. I was But there's a lot of red flags with this trade. This is one of the few ones that made it like a perfect example to talk about for if you're looking at options and you're looking at pricing and stuff like that. Don't ever see something like this if there's not earnings. So a lot of times that'll signal there's an earnings in here, and that's while volatility is spiking. Well, they already had their earnings, so I already know that is out of the way. So I know now that that is an opportunity to take advantage of the pricing. But if there is, you go back, you see this anomaly and you go to the chart, you see there's an earnings in the next day or two. Well, there's your answer. That's why. And you wouldn't necessarily want to do this strategy for that. Does that make sense to everybody? Logic? I mean, is that logical? Does that make logical sense? All right. So ultimately, we know that these premiums are pretty cheap, right? Based on our analysis of that pricing. Because really, when we're looking at the option montage and we're looking at the implied volatility percent, all of those things, we are trying to determine whether they're cheap or expensive. And we did that. So we are going to be looking at buying options. And with a long call calendar, we are obviously buying because it's of long. We do have to think about this thief in the night. Now, this is a representation of what happens to your options pricing. This is those prices that we were looking at in the option montage. And what will happen, all else things considered, the underlying doesn't move. Let's just say that the underlying doesn't go anywhere. Sorry, I'm trying to find my pen that I want because white doesn't show up on this one. All right, so and it's not linear. It means it's not binary. It's not linear. It's not going to happen exactly the same on every single day. You can see that as the closer we get to expiration, that erosion, you can think about this as erosion, starts becoming more and more aggressive. Out here, you would see that this number would kind of start to flatline out a little bit. It will never be completely flat because theta, this thief in the night that comes and steals your premiums, will never relent, all right? As soon as an option's created, thief in the night is coming in there and picking those premiums, okay? He just gets really aggressive the closer to expiration. So what we look at is outside of 70 days is where I'm looking at we buy options, okay? And then inside of here, we want to take advantage of that theta, right? You want to sell high, buy low. We talked about that with the options pricing. We want to buy them when they're cheap and sell them when they're expensive. Well, another way to get that in your favor is to have the thief in the night, erode those premiums, right? That means you're selling high and buying low. If you sell it, it doesn't go anywhere, and that erosion happens, all right? So sell zone inside of we're as close to 35 days to expiration is what I usually say. 45 days, getting into a strategy for, taking advantage of that theta decay is about right as well. But the buy zone, I like to get outside of 70 days to limit that theta decay during the life of my swing trade is really what I'm looking at it as. And we can see that theta really ramps up if we look at the option montage. Now, we already talked about Vega, right? But now I want to talk about theta. Theta is always eroding options, so that's why it's negative. You can see in the column all the way down the page is negative because you can't stop time. All of these Greeks are on the assumption that it is moving forward, right? A day goes by. The underlying goes up by $1. The volatility goes up by 1 percentage point. Okay, so all of the Greeks assume one move forward. All right, you can't go back in time, and theta is always negative. We can take advantage of it though by if you sell an option and that negative becomes a positive to your position. All right, but anyway, look at how big theta is with like just 8 days to go. You saw that last chart. After 7 days, it falls off a cliff. It even starts getting more aggressive. At 35 days, it's about half as aggressive, But know that, moving from 36 days to 8 days, you can see that during that duration, my premiums are going to double, or that theta component is going to double, right? During these next 20 or 30 days, it's going to double. Now, I said we want to go outside of 70 days. We could look at the August contract as well. I was just looking at the set on these. What was I going to say? So the component is 3. Yes, it does almost double, but it only goes up by 3 cents, where this one went up by almost 7 cents going there. So we want to limit the theta decay. That's why we go out further, because you can see that that theta decay doesn't ramp up as fast. And we want to take advantage of theta decay inside of 35 days. So when you're buying options, get out in time. When you're selling options, you want to get a little bit closer to that expiration cycle. Okay. That's another, like I said, I'm trying to get you guys in a place where we've turned those tables in our favor. One of the ways that we do that is by, looking for swing trades, looking for that pattern setup, looking for that momentum shift. That's key. The next thing to really get the probabilities in your favor is to trade with options. So when we're looking at this strategy, and I was a little bit concerned, remember, about the volatility coming out a little bit. So I kind of want to isolate some of that volatility, even maybe some of the theta decay, because I'm, thinking towards, if this implied volatility is low, that they're pretty cheap. All of those things, I'm still leaning towards that buying of an option, but maybe I want to limit some of those risks involved in that volatility. But if I'm looking at this chart setup, I look at that as a bottoming pattern, very near a support level, confirmation today to the upside. I'm looking for a target right in and around here. If I wanted to be safe, I could go, okay, well, 135 is kind of like where I'm looking at for a line in the sand for this underlying to move to. Any break, on an out, I would be looking at any break below this Fibonacci, or the 78 Fibonacci. So all of those things, I'm thinking longer duration for Apple. I want to kind of, play it going into that next earnings. They're, releasing a new phone relatively soon. I don't know exact date of that release, but I think they're coming out with another new phone here. So heading into that, I think there's going to be a lot of positive noise around Apple. So I'm going to try and play that. And we also know heading into earnings, those binary events, that volatility starts spiking. That's a given, if you will, if you're looking at like geometry and a given. Usually going into those earnings, that's like a given. We're going to see volatility increase. So that, if I'm buying an option in this contract, right? Well, I can set myself up even more so for success, knowing that if volatility goes up, what happens to my premiums? They go up also. Even if I'm directionally wrong, if volatility goes up, folks, those premiums go up. So that's another reason why we're trying to set ourselves up for success, right? Right during the pandemic, we were seeing calls, the premiums go through the roof, right? And the underlyings were going down. So people were standing to make money on those calls, despite the fact that they're directionally wrong. So that's another reason why we use options. Is sometimes, like, if I had a bullish assumption in an underlying, and very, 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 very rare cases, I buy a call for a bullish move and the underlying goes down, and those calls go up in value because of volatility. I can get out for a scratch or maybe a smaller loss than what I would have normally have felt had I been involved in the stock. Okay, so trying to, all the risk reward, all of those things turning in our favor. So looking for a long haul, worried about volatility, I'm leaning towards this long call calendar. Those are the reasons why. I want a longer play to the upside, heading into maybe that earnings and this capture this new phone that's supposed to be being released, all of those things. Whatever your thesis is for your trade, right? That is my long-term trade. I'm a little worried about this volatility, so maybe I want to limit some of that as well. So I'm going to lean towards this long call calendar. So finally, we're at that point in the webinar where you guys have been like sticking around. I mean, holding tight. Hopefully you guys have learned a lot so far. But now we're going to be talking about the strikes and why. But first we need to talk about one more Greek, and that's delta. All right, delta tells us the rate of change in the option premium, blah, blah, blah. All right, whatever. Yes, it does. So when the underlying moves up by $1, your premiums are going to increase by the corresponding delta. All right. But on the floor, we used to talk about this as data. All right. I talked about it earlier. It's the data, it's the odds, it's the probability. All right. It's the probability of success. All right. That's what we're looking at. Delta tells us our probabilities of success with this. So when we're trying to build a strategy out with this, we need to look at the standard deviation curve. All right. And I'm going to be looking, if this is the, let's say this is the call side and this is the put side, right? Because these are negative standard deviations. Underlying is currently trading right here at 0. This is for any type of trade. If you are setting up a trade with the stock, this is your standard deviation curve. This is where you get involved. That means probabilities of that happening, probabilities of that happening are 50-50. All right. Now, when we're using options, we can figure it out what our probabilities of success are. And we're going to be looking at this one standard deviation, right, for the long duration. It is going to be about a 35 delta. You know, it's right around 32 standard deviation, but we're going to be looking right around that 35 delta, which is basically a 35% chance of being in the money. Okay, that's what the standard deviation curve tells us. This is, you know, the 32% chance of happening from that one standard deviation. I think it's right around one standard deviation, that 32% chance of the underlying doing this, and basically a 68% chance of the underlying doing that. Now you might be saying, Wolfman, you got the probabilities that aren't so much in your favor. Well, this is over the next 172 days, right? The other thing is, I also know, this is a floor trader hack, 2 times the delta, and I forgot to say this in the last couple of webinars. That's why you should watch all of them, right? 2 times delta equals your probability of touch, is what we used to call it. All right, probability of touch. During the life of this option, the delta tells us the probability of being in the money at expiration by at least 1 penny. That's at expiration. Now, this floor trader hack is 2 times the delta is the probability of touch. Now, so that means that this is I'm saying a 70% chance of a touch. That's all we're looking for in a swing trade, right? Is for the market to move and hit one of our support and resistances or whatever. Well, I've got a 70% chance of that happening. So that's pretty good. That's all I'm looking for, is the underlying to go up and hit that area that I talked about as resistance. For Apple, I pointed it out. It was right around 135, 137, somewhere in that area, right? So that's what I'm going to be looking at if I'm trading the options, is on the long call calendar, the first thing I'm going to do is look for the long. Now, if you're really aggressive, you know, or you can play it at the money. All right, that's going to be about the 45 delta. I like to do a 36 delta. If you do it at the money ones, you're going to need a little bit of a pullback probably to be comfortable. All right, so if you were looking at this, you know, wanting to get long, not wanting to miss out on it, but it wasn't like maybe a good chart setup, then maybe you would want to get closer to the at the monies, all right? Because then that near duration short call will expire relatively quickly for you, which is good for your overall position if you're still long-term bullish. All right, you can have those short-term pullbacks. And one of the reasons why I was looking at SPY and the NASDAQ for this strategy is because I've been talking about it in the daily market commentaries. I think we're going to see this volatility for the remainder of 2021 where we get these nice bounces, which is healthy for the overall markets, and it's good for trading, to be quite honest. But I like to look at the out of the money. I like to go, this is going to be a lot less. I'd like to go here first and look for that 36 delta to buy, all right? And then, you know, with this one, it's the same strike. That's the big deal with the calendar is it's the same strike. The diagonal are different strikes. And we'll talk about the diagonal, like I said, next week. But we're using the same strike. So this is easy. I'm going to that out of the money, 36 delta, as close to that 36 delta as I can get. That's the one I'm buying, and then I'm going to go to the near duration and sell that same strike. Okay, but I also want to build it out, excuse me, where I want to be able to risk one to make one ultimately, and the only way to do that is on the Analyze tab easily. But you can see I go out here and look for as close to that 36 delta option. It's the 37. And I did the 135 calls, right? You can see the 135 strike going all the way across. This is for the calls, right? They only do one strike call. All right, so I go around that 35 delta, and then I look at the 135s, boom, easy choice. 135 is the one I'm going to sell, all right? We'd pay $384 debit, all right, on this strategy. So you know your risk is only $3.84. And remember with options, even though it's a one lot, it says, you know, $3.84, there's an option contract multiplier in there. That's because every one contract in options is equivalent to 100 of the underlying. That means if we took our right to buy the stock, the call, you know, if I bought a call and I took my right to buy the call at 135, you know, if I bought a call at the 135 strike here and I decided I want to buy it at 135, then it would go in my P&L as I own Apple at 135. But I'm also going to have 100 of those in my portfolio. Okay, for every one contract, it's 100 of the underlying. Hope that made that clear. All right, so in this case, we'd be risking $384. All right, so during the life of this trade, our, you know, risk analysis, our max profit on this is going to be about 375. Our risk is right around the same as well. Now, if this option expires worthless, right, we collected a credit for that trade, right? When I go back to this, I buy here, I'm buying these options, and I'm selling these options. Selling a call and I'm buying a call, right? So when this option expires and the underlying didn't go up to 135 yet, well, I still own that long call, and my, you know, risk to the upside, or my reward to the upside is unlimited. All right, my risk to the downside is still limited to this debit I paid. Okay, that's always my risk. All right. Yes, you could go out after this one expires. You know, if this one's only like even worth 10 cents, you know, it gets down to 10 cents, I'm probably looking to cover this, get out. But then, you know, I would look to go out here and sell another call. All right. Hopefully you can go out and sell the 140 call, you know, move out in time and up higher. That would be ultimately what you would want to do. Lower this overall trade to where you own it for zero. That would be awesome, where you can own this call for zero. That would require rolling out, you know, throughout time, those short calls to try and collect enough credit to pay off this entire debit. All right. What makes you choose the 37 delta? Why there? Well, Tom, for one, it is that one standard deviation. That is going to be a place where a lot of people trade. You know, do Fibonacci's it work because of some natural, you know, phenomena in leaves and in conch shells? Well, maybe, maybe not. I don't know. Or is it because everybody and their brother uses Fibonacci and they're all looking at the same lines in the sand, right? Really what it comes down to, though, for me, Chris, is, Tom, is the probabilities. I know my probability of touch is 70%. That's pretty good. And for the risk of only, you know, $384, that's another thing. You know, some people will talk about, Tom, you know, going to the in-the-money options. They like buying these real far out in the money options. Why? Because the probability of being in the money is much better. You know, you got an 84, you know, 50, 60% probability of it being in the money. But folks, that's by 1 penny. That means it could go all the way down there to 120.01. Well, it finished in the money, but only by a penny. And that means your option's only worth a penny. You lost a lot of money on that trade in that regard. So for me, the risk reward, my risk, I know is a lot less than if I were doing it in the money one. The reward is going to be better versus what I risked. All right, your risk reward is much better on a trade like this versus doing something in the money. And knowing the probability of touch, 2 times that probability is pretty good. Does that make sense? 70 some odd percent. But it lines up with a lot of those different coefficients, which is ultimately why I like to pick that straight. Do you let the short-term option expire? Yes, I would probably let it expire. But really, to be honest with you, Chris, if I saw that short call trading for a dime, I'd cover it. I mean, anytime I'm short an option and I can cover it for a dime, that's usually kind of like dime or a nickel. If I'm squeezing it, I'll go for a nickel. But for the most part, I get out of short options for like a dime. I don't care about that extra 10 cents for the risk of losing everything I had made on that trade. It's not worth it for me. So that's when I'm going to look to get out. All right. So, and if that short call, like I said, is looking to expire worthless, and maybe roll it out and higher to the 140. The beauty in this is that lines up with that, you know, resistance area that we showed on the chart, right around that 137 area, which is another reason why I picked that as well. Picking up times instead of a steamroller. Yes, we used to say that about right now. Like if you are selling 30-day Fed fund futures, you are trying to pick up dimes in front of a steamroller because you're going to get run over. But yeah, we used to always say that on the floor. Sometimes, you know, people trading like, you know, 1 delta or 5 delta options and selling those. I was like, dude, like you are a black swan event's dream come true. All right, so where do we get out? Ultimately, what we're going to look at for this trade, if during the life of that short option, get out when the short call is breached. All right, get out if the short call is breached. All right, and keep rolling that up and out in time. All right, that's going to be your max profit basically if that short call is breached, folks. Yes, you can try and whittle out some more from it, but for the most part, trust me, it's not worth it. Get out when that short call is breached. That's going to be it. The only way to really achieve this exact max profit during the life of the short option is if it's your short by short call, then you know the underlying was trading 134.99. Okay, right? Because then my short call expires worthless. The only way to achieve that exact max profit is when my option expires, the underlying settled 1 penny below me. All right. Again, not worth the angst and trying to get those last couple of pennies, folks. I would much rather just cover it for a dime and get out. But that's how that's all based on and realized. Hopefully we let that option or take that option off during the life of this, right? Or, it's going to break down. I write these things out. I'm going to break down if it's breached my short call or I break the pattern, right? The pattern I got set up on. So yesterday's candle, I got today's confirmation. Yesterday's candle is where I'm going to get out. You can say, or breaks the Fibonacci, right? The beauty of this strategy, though, folks, is if you have a higher risk tolerance, and this is, these are some, especially on breaking the pattern for newer traders going on swing trades. The beauty in options here, especially with this strategy. If I pull up an Apple chart, I don't think I have one right now. This is the square chart. This is why I haven't really done anything on square. It's come down and found this support though. So I am considering it. They've already had their earnings. So this is something that's on my radar for that trade, for a swing trade. I'm just waiting for it to turn around. All right, so now I'm going to wait for something like that to get confirmed. There's too much bearishness going on. Why did I pull up this? For max profit. Breaks below this, I'm probably going to stay with it. But the beauty in this is normally if I were to get long in the stock, I'm going to be like sitting on pins and needles if it breaks below this area right here. With the options, I've already got kind of like a synthetic stop in there, right? I don't have to worry about, any worse than that $3.85. My 35 strike, I'm looking to get out if it goes up there and tests that. That's going to be where I'm getting out on the downside. If you have a lower risk tolerance, get out here. But for me, I'm basing this on a swing trade. I could say with this contract, I'm willing to lose the money on it. So, I can just set it and let it go if you have a higher risk tolerance. And that's how I usually do it, folks. It's because I'm playing out those probabilities. If you're getting in and out too soon, those probabilities aren't necessarily getting hammered out exactly correctly. All right. So I like to lean towards the probabilities rather than, necessarily my chart breaking down more than anything. Like most people would say, breaks below here, yesterday's bottom, that's where you're out. But because it's so close to this point of control, I'd be more willing to stay in this a little longer. Does that make sense? So I'm playing it on that, but tomorrow if I got into this trade and it started selling off, I'd be kind of all right with that because with the long call calendar, I want that short call to expire worthless anyway, right? And then resume it. Would be a perfect scenario for me, or just kind of bounce around here for a moment and then resume its rally. So those are the things that I would be looking for, and the beauty in options. I was saying, why use options? You're turning the probabilities in your favor, all of those things. Well, it allows you to stay in this trade longer because, if you're in the stock, it feels like you're just following that whipsaw if it's just pinging back and forth right around this point of control. Whereas in options, I do have to worry a little bit about theta decay, but I've also got this short call strategy kind of helping me out, and that's keeping my powder dry for me. I'm just waiting for this pop to happen, right? So, like I said, it allows you to keep your powder dry longer. And another thing with this strategy specifically, I'm able to play this out, and I'm going to use a heck of a lot less margin in my portfolio, right? If I bought the stock, that's going to be a lot more margin out of my portfolio than doing this option, $384. I could only basically do two of these, 2 1 lots, right? And I'll make more money on the option. So risking less, to the downside, and my reward, that means my return on investment is through the roof compared to going out there and buying the stock. All right, folks, listen, we are down to single digits on how many more we're going to accept for members for the Charter Member Club, where it gives you instant access to me. You guys get unlimited access. This says during office hours, but you guys know that have been taking advantage of this. I'm sitting at my desk at 8, 9 o'clock at night looking at charts, so I'd be happy to shoot you an email to make sure you're clear of concept. So I'm all over that. So take advantage of that. You have a mentor basically wrapped into this package, and you get access to all of my webinars, past, present, and future. So take advantage of that. Daily market commentaries, where I talk about all my option strategies, when, where, and why I put them on. You can click on the link that's over there in the chat window, throwing it in right now. That gives you a hot link to this. Like I said, we're down to single digits on this offer. I just want to thank you guys all. Later webinars, I'll drill down on different option components, when and where I find those. Also, you can reach out to us with any questions, comments, or ideas for future webinars at 310-598-6677 or trading@protraderstrategies.com. Finally, take a moment to go over a disclaimer. No, I'm not trying to talk you into buying Apple when I'm using that as a real life example. Anytime I'm talking about my trades, it's up to you guys to be big boys and girls to decide whether or not those trades are appropriate for you. So please pause and read over this. That's all I got. Like I said, take advantage of this because you do get complete access to me as a mentor. All right. Chris, one last thing. What do you got? How do you set up the price volumes on the right-hand side of your chart? Chris, I've got a whole video of that, how to do the monkey bars and the volume. You can look them up and do them. I also show you how you can break it down to something like this where you can get it intraday. All right, cool. All right. Oh, wait, one last thing. What's that? Blew me up real quick. What you got? Oh, okay. Perfect. Thanks. Appreciate all the kind words, everybody. One last thing, if you like this video, please smash that like button. It does help. And if you have any questions, comments, or anything else, throw it down there at the bottom. I will make sure you guys are clear on concept. We'll talk about it. Whatever you have to talk about down there. All right. So smash that or take that. All right. Bye for now. Take it easy.